Hi, I'm Jessica Amir from the Finance News Network at the Self-Managed Superfund 2017 Summit, and joining me from Contango Asset Management is MD and CIO George Boubouras. George, welcome.
Good to be here.
So George, can you tell us what is your key takeaway message for Self-Managed Superfund trustees?
Yes, key takeaway going into 30 June is our annual health check, is understanding what returns you're looking for. Do you want more dividend income in your equity asset class or capital gain? That is a different portfolio to construct. Do you need more global versus domestic? How much fixed income do you need in there, cash? And what are your personal circumstances as well? So the takeaways are, have I got the right portfolio for the right stage of my life that reflects the right phase of my pension phase, pre-pension phase or post? So there's a number of things you need to go through, but these are annual health checks. So plenty of key takeaways to look at.
So George, where should investors be looking for income?
Well, income obviously start with term deposits. They're very low, those rates, and they'll stay lower for much longer as the RBA, the Reserve Bank of Australia, will keep cash rates at historic lows for, we think, years to come. And that will create demand for people that when they're rolling those term deposits, they need more income for their lifestyles, particularly in pension phase. What you find is that there's a lot of demand with an ageing demographic as well for dividend income to be a part of the contribution to your overall income. So Australian equity market, for example, conveniently offers a very high dividend yield versus other equity markets around the world. What we say is there's high payout ratio, so a lot of that cash is spun out as a dividend, and it's a reliable one, again, versus America, Europe, Asia, and the UK. So Australia can offer that, and you're finding a lot of dividend income equity style demand products as that ageing demographics looking for that. To give you an example, you can quite comfortably get a 5.5% dividend in an equity portfolio in Australia, and overseas a 2% dividend yield is a very good outcome. And that's what people are doing more and more. So they're looking at Aussie equities increasingly for their dividend income and franking, and global for growth and less income. Any
particular asset classes?
Equities in particular. So generally in Australia, infrastructure, listed property trust, for example, some good quality industrial names, the big four banks, Wes, Woolies, consumer staples, they all contribute to a good healthy dividend stream through a cycle. Even industrial companies like Ansell or Brambles and insurance companies like QBE. So they generally pay out higher dividends relative to their peers offshore. But the big four banks stand out. They very much stand out in a very high and reliable dividend versus their peers offshore. And that's increasingly becoming an important contributor to a self-managed super fund retiree in the right pension phase scenario.
So, George, where do you think the best growth opportunities are?
Well, growth, if you want quality growth, you need to really much go to Healthcare Australia. So CSL is just one of our favourite core quality global growth companies. So CSL, ResMed, Healthscope, for example. Healthcare tends to be good quality growth in the large cap. And then in the small or micro cap, that becomes riskier. But something like Cogscape is a small company, healthcare, that does work with Eli Lilly in North America, which is a very large pharmaceutical player on things like cognitive sort of solutions for amnesia and stuff like that. So these are things that are pretty important. But healthcare generally are your quality plays. But you've got to go offshore. That's the missed opportunity for a lot of self-managed super funds. When you go to a global manager and they're buying things like Amazon or Facebook or Tencent or Costco, for example, or Cooper, which is the largest contact lens producer in the world. There's so many missed opportunities when you go offshore, and you can do that by buying global fund managers. So global for quality growth, domestic healthcare for quality growth, smaller micro-cap for riskier growth, and large cap Aussie equities, the big four banks, top 100 companies for dividend income. So that's your blended solution, and that generally goes a long way to meeting most people's expectations.
Well, thank you so much for your insights, George Boubouras from Contango Asset Management.
Good to be here, thank you.